Hello and welcome to RCLCO's February macroeconomic update. I'm Scott Bommarito, Vice President of Research at RCLCO Fund Advisors, and today I'll be talking us through a couple of the major economic developments over the last month or so. One of the major headlines that we saw was the January jobs report, which had a little bit of good news and then a little more bad news. The good news was that the January growth surprised on the upside, totaling about 130,000 new jobs for the month. However, that positive development was mostly drowned out by the Bureau of Labor Statistics job growth revisions, which were also published in the report. Those revisions took cumulative job growth for 2024 and 2025 down by about a million jobs. So 2025 job growth, which in the original estimate, was at about 600,000, so already fairly low. After the revision, that was brought down to 180,000. So weaker job growth than previously estimated for 2025. And then as this chart on the right shows, each month across the board for the year was revised down. Now, returning to the January 130,000 job growth, we expect that to be brought down again as well. This follows the trend that we've seen over the last couple of years with downward revisions in those preliminary monthly reports. So overall, weaker job growth over the last couple of years, which we expect to persist going forward as the U.S. population growth slows, both natural population and immigration. Elsewhere in the report, though, there were some signs that were somewhat more positive, somewhat more encouraging. So to start with, the unemployment rate remains low at just 4.3% in January. That's trended up slowly over the course of the last several years from the record low unemployment rates that we saw in 2022 and 23. However, 4.3% remains very healthy by historical standards. Similarly, the number of unemployed individuals in the labor market has trended upward, despite ticking down a little bit over the last couple of months at 7.4 million. Another noteworthy comparison is that at the same time, job openings have trended downward as well, and those fell down to 6.5 million as of December. Those figures released 1 month in arrears. This represents a shift in which the number of unemployed is now higher than the number of job openings in the economy, after several years of having more job openings than unemployed. Now, I'll note that by historical standards, this is normal, and that the ratio of job openings to unemployed remains more favorable than the longer-term average, but it is an adjustment from what we've been used to seeing the last couple of years with really very steady job openings. Elsewhere in the employment market, another encouraging piece of news: wage growth remains strong at 3.7% year over year in January. That's notably above CPI inflation, which recorded 2.4% in January. And wage growth has trended above inflation for the last couple of years since early 2023. So the labor market continues to post real wage growth, even as job growth begins to cool. So taken as a whole, the labor market looks to be bending, but not breaking. It's bending as job growth is revised down and has a lower outlook going forward, and as job openings cool. But it isn't breaking in that unemployment remains healthy and wage growth also remains meaningful. So taken together, this isn't cause for alarm, although it's certainly a moderation from some of the records that we've seen over the last couple of years. Elsewhere in the economy, turning to the housing market, some breaking news, hot off the press, that the 30-year fixed rate mortgage rates have fallen below 6% for the first time since 2022, recording 5.98% in this last week of February. This is more of a psychological effect than it is a real economic development. After all, rates only came down a couple basis points from the prior week, but it is nevertheless, an important development as interest rates moderate. Looking forward, we expect the 10-year US Treasury yield to remain in this band from 4 to 4.5%, where it's held steady over the last couple of years. And at historically average spreads to mortgage rates, that would imply about a 6% mortgage rate going forward. So we don't think that there's much room for mortgage rates to compress further, and we do expect them to remain about steady, maybe coming down a little bit more, but unlikely to drop below 5.5% in the midterm, and more likely to stay around the 6% that they've been at over the last couple of months. That concludes our February macroeconomic update. Don't forget to follow along for more webinars and updates. And of course, feel free to reach out to us if you have any questions.